Welcome back to the Success Blueprints channel, your personal finance and investing channel, where we help you grow smarter with your money, saving and investing, and the world of cryptocurrency. Today's video is all about avoiding some of the most common mistakes in crypto investing that can end up costing you big time. So grab your notepad, get comfy, and let's dive in. Alright, let's kick things off with mistake number 1. Investing without doing your research. Crypto moves fast. There's always a new coin popping off, and it's easy to get caught up in the hype. But trust me, jumping into a project blindly is like playing financial roulette. Remember that time everyone was going crazy over Squid Coin? Yeah, that turned out to be a massive rug pull, and a lot of people lost a lot of money. Don't let that be you. Instead of chasing hype, take the time to actually understand what you're investing in. Start by reading the project's white paper. This is basically the blueprint of the cryptocurrency. It outlines its purpose, its technology, and its goals. What problem is this cryptocurrency trying to solve? What makes it unique? Who are the people behind it? A little digging can go a long way in separating legitimate projects from the fluff. And don't just stop at the white paper. Look for real-world applications. Is the technology being used by actual businesses? Are there partnerships with established players in the industry? These are all signs that a project has legs to stand on. The bottom line is this: treat your crypto investments like you would any other investment. Let's talk about mistake number 2, which is something that applies to all investing, not just crypto, not diversifying your assets. This is especially important in the crypto space, which is known for its volatility. Think about it this way: putting all your eggs in one basket is risky, no matter how strong that basket seems. If that basket were to fall, you'd lose everything. But if you spread your eggs across multiple baskets, even if one or two take a tumble, you'll still have the others. The same logic applies to your crypto investments. Instead of going all in on one or two coins, spread your risk by investing in a variety of projects across different sectors of the crypto market. Think about it like building a well-rounded investment portfolio. You might have some Bitcoin and Ethereum as your core holdings. Those are like the large cap stocks of the crypto world. Then you could branch out into smaller, potentially higher growth altcoins. By diversifying, you're essentially hedging your bets. This way, if one asset takes a hit, you're not losing everything in one go. Alright, moving on to mistake number 3. Neglecting wallet security. This is a big one, guys. In the world of crypto, security is paramount. Unlike traditional finance, where you can often recover lost funds or reverse fraudulent transactions, crypto transactions are largely irreversible. Once your crypto is gone, it's usually gone for good. That's why it's crucial to take wallet security seriously. Think of your crypto wallet like your digital vault. You wouldn't leave your physical vault unlocked and unattended, right? So don't do the same with your crypto. There are two main types of wallets: software wallets and hardware wallets. Software wallets are apps that you download onto your computer or smartphone. They're convenient for everyday transactions, but they can be vulnerable to hacking if your device is compromised. Hardware wallets, on the other hand, are physical devices that store your private keys offline. They're like USB drives, specifically designed for cryptocurrency. Because they're not connected to the internet, hardware wallets offer an extra layer of security against online threats. Now, regardless of which type of wallet you choose, there are some essential security practices you should always follow. First and foremost, use strong, unique passwords for all your crypto accounts. Use a combination of upper and lowercase letters, numbers and symbols. Better yet, use a password manager to generate and store your passwords securely. Secondly, enable two-factor authentication whenever possible. This adds an extra layer of security by requiring you to enter a unique code from your phone or email in addition to your password when logging in. And lastly, be wary of phishing scams. Let's move on to mistake number 4, which is a common one among both new and experienced investors. Trying to time the market. It's tempting to try to buy low and sell high, riding the waves of the market to maximize your profits. But the truth is, timing the market consistently is incredibly difficult, even for seasoned professionals. The crypto market in particular is notoriously volatile. It's driven by a complex interplay of factors, from news and regulations to sentiment and speculation. Trying to predict its every move is like trying to predict the weather months in advance. It's nearly impossible to get it right consistently. Instead of trying to time the market, focus on what you can control. Your investment strategy. One popular strategy, especially in volatile markets like crypto, is dollar cost averaging. This involves investing a fixed amount of money at regular intervals, regardless of the price. When the price is down, you'll be buying more Bitcoin for your money, and when the price is up, you'll be buying less. Over time, this strategy can help you average out the price volatility and potentially reduce your overall risk. The key is to be patient and disciplined with your investments. Now let's talk about the final, and perhaps most important, mistake to avoid: emotional trading. This is something that can trip up even the most experienced investors. We're all human and we all have emotions. But when it comes to investing, letting your emotions guide your decisions can be a recipe for disaster. Fear and greed are two of the most powerful emotions in investing. When the market is going up, also known as a bull market, it's easy to get caught up in the excitement and FOMO, the fear of missing out. You see everyone else making money, and you don't want to be left behind. This can lead to impulsive decisions, like buying high out of fear of missing out on further gains. On the flip side, when the market is going down, also known as a bear market, fear can set in. You see your investments losing value, and you start to panic. This can lead to selling low out of fear that things will only get worse. The problem is, these emotional decisions often go against logic and sound investment principles. So, how do you avoid emotional trading? The key is to have a plan and stick to it. Before you invest a single dollar, take some time to define your investment goals. What are you hoping to achieve with your investments? Are you looking for short-term gains, or are you in it for the long haul? Once you have a clear understanding of your goals, you can start to develop an investment strategy that aligns with those goals. It's also a good idea to establish stop-loss limits. The most important thing is to be honest with yourself about your risk tolerance and invest accordingly. So there you have it, 5 common crypto investing mistakes to avoid. By steering clear of these pitfalls and following these tips, you'll be well on your way to making smarter, more informed crypto investing decisions. Thanks for watching, and I'll see you in the next video. Don't forget to like, subscribe, and share this video. Visit our website for more information.